So I just wanted to go over a little bit more detail into uncollectible accounts and what do we do when something is basically, how do we represent uncollectible accounts? Basically, once we are selling on credit and we have an account called accounts receivable, think about it. If you're not actually going to collect on that, then there could be a material error on the balance sheet where you say, oh, though that's your equity, but I mean, that's your assets and equity, but really it should be less than that because some people are not going to pay you back. Um, Not that we're making this up or being pessimistic. Think about credit card companies. Not everybody always pays the balance on time, or I mean, or in general, some people don't pay off their balance in the end, and that's why they have that. I think they charge the vendor when you use a credit card like 2-3% or 4% because that's part of their model. That some 95 or 6% of people pay, and sometimes they don't. So that's where it comes from, and the idea is essentially when we have a transaction. Let's go back to our flower shop. For example, say you sold $10,000 worth of flowers on credit. What you do is you book a debit to accounts receivable for 10,000, a credit to sales for 10,000. But this was on credit, so they're gonna pay you. Say you're gonna pay you the next 30, 60 days. So say just from your dealing with this kind of thing in the past, say you've done this 10,000 times already, and you noticed every time, 3 people out of 100 don't pay the full thing or don't pay at all. So you can use a percentage actually, which is something a lot of companies do, and you say, hey, I'm gonna say 3% is not collectible. That's just how it's been over the years. So you could do that, or the gap says in order to be completely accurate, you do that right away. So how can you do that? You could say bad debt expense 300 is a debit, and allowance for bad debts is 300. Now what do these accounts mean? This is income statement as a basically negative amount, reduces the income, and this is going to be on your balance sheet a contra asset, reducing the AR. So in other words, your AR on the balance sheet will show net of this whole thing as this, because this is the true thing. In reality, hey, if you have a model that says, hey, 3% of amounts I don't collect, the true amount of the AR here is 9,700. Now that's kind of what we talked about. There's a little bit of an estimate game in certain parts of accounting, and this is part of it. Now you don't know if they're going to pay you or not. Say they do pay you, you may need to remove this 300 out of the allowance for bad debts. So you may need to remove it, and basically remove the expense as well for this particular one. Or if they didn't pay you the 300, you write it off by saying, hey, I'm going to remove this out of the receivable completely, not just as a contra asset, but I'm going to take it out completely, and I'm going to cancel out the allowance, because the allowance is just kind of like a placeholder for now. So there's a little bit of a trick with this, how it flows, and it's just something to look into, and it's just a way to basically wait a little bit to see if they're going to pay you or not, and then if they don't pay you, you write it off. If they do pay you, you get rid of this contra asset. But it's like a little bit of a game of how to account for essentially what is an estimate.